Welcome back, future CPAs. This is part 4 of our series, Performing Further Procedures and Obtaining Evidence, which covers the third area of the Auditing and Attestation section. If you're new here, don't forget to hit subscribe and share this with your fellow CPA candidates who are looking for quality review materials for free. This program is built to help you learn more efficiently in less time. We start with multiple choice questions as the foundation, then zoom out to connect them with key topics and align everything with the AICPA exam's representative tasks. The visuals are kept minimal on purpose, so you can also treat this like an audiobook, perfect for maximizing your study time on the go. Wishing you the best on your CPA journey. All right. Question. Which of the following procedures would provide the auditor with the most reliable evidence about litigation, claims, and assessments? A. Inquiry of management. B. Reading minutes of Board of Directors meetings. C. Obtaining a letter of audit inquiry from the entity's attorney. D. Examining correspondence with regulatory agencies. The best answer is C. Obtaining a letter of audit inquiry from the entity's attorney. Let's break this down. Inquiry of management is always a starting point, but it's internal and not sufficient by itself. Reading minutes of the board can give important context, like whether legal contingencies were discussed, but minutes won't cover everything. Examining correspondence with regulatory agencies can help, but it still comes from management's files. The attorney's letter, on the other hand, provides direct external evidence from the party most knowledgeable about pending or threatened litigation, making it the most reliable. That's why the correct choice is option C. Now, let's look at the relevant AICPA exam task. Perform appropriate audit procedures, including inquiries of management and others, reviewing minutes, and sending external confirmations to detect the existence of litigation, claims, and assessments. When auditors evaluate litigation, claims, and assessments, the goal is to detect potential obligations that could require disclosure or accrual under accounting standards. The blueprint task focuses on performing appropriate audit procedures, including inquiries, reviewing minutes, and sending external confirmations. 1. Inquiries of management and others. Management is usually the starting point. They know about disputes, investigations, or claims. But inquiries alone are never enough. Management may be unaware of certain matters or, in some cases, may not fully disclose them. Auditors may also inquire of in-house counsel or those charged with governance for additional perspectives. 2. Reviewing minutes. Board of Directors minutes often reveal discussions about lawsuits, regulatory investigations, or major disputes. Even if incomplete, minutes help auditors identify red flags and corroborate other information. 3. External confirmation through attorney's letters. This is the most reliable form of evidence. Under AUC 501, auditors request a letter of audit inquiry to external legal counsel. The attorney is asked to confirm the existence, nature, and likely outcomes of litigation, claims, and assessments. If management refuses to permit the auditor to contact attorneys, it's considered a scope limitation, which may result in a modified audit opinion. 4. Reviewing correspondence with regulatory agencies. Regulatory letters, investigations, or compliance notices may indicate pending litigation or exposure. While helpful, they must be corroborated with attorney responses and management's representations. Key takeaway: the most reliable evidence comes from external legal counsel, not management alone. But the auditor must combine all of these procedures to build a complete picture. Inquiries, minutes, correspondence, and confirmations all work together. All right, next question. An auditor is performing planned procedures to evaluate whether substantial doubt exists about an entity's ability to continue as a going concern for a reasonable period of time. Which factors would appropriately be considered? Let's go one by one. Statement 1. Recurring operating losses, negative operating cash flows, and violations of debt covenants. Yes, These are classic financial conditions that may raise substantial doubt. If the entity can't generate positive cash flow or is breaching covenants, it may not survive without restructuring or external support. Statement 2. Loss of a major customer, labor difficulties, and dependence on a single supplier with uncertain future operations. Yes, these are operational factors that could threaten an entity's ability. Losing a big customer or facing supply chain instability directly impacts the business model. Statement 3. Pending litigation, adverse legislation, or regulatory changes that could significantly impact the entity's future operations. Yes, these are external factors that could severely impair operations or solvency. Statement 4. Substantial doubt exists whenever there's a temporary decline in quarterly net income. No, a temporary dip in profits doesn't automatically create substantial doubt. Standards require evaluating conditions and events collectively to assess whether there's a reasonable expectation that the entity will meet its obligations over the next year. So the correct answer is statements 1, 2, and 3. The correct choice is option C. Let us look at the exam task on going concern. Identify factors that should be considered while performing planned procedures that may indicate substantial doubt about an entity's ability to continue as a going concern for a reasonable period of time. When auditors perform planned procedures, they must consider whether there are conditions or events that raise substantial doubt about the entity's ability to continue as a going concern for a reasonable period of time, typically 1 year from the date the financial statements are issued. 1. Financial indicators. Recurring operating losses or net losses. Negative cash flows from operations. Adverse key financial ratios, for example, liquidity or solvency ratios. Default or violation of loan covenants. Denial of usual trade credit or inability to obtain financing. 2. Operational indicators. Loss of a major market, customer, or supplier. Labor difficulties, strikes, or shortages of critical staff. Dependence on a single project or source of revenue. Ineffective operations or inability to adapt to changing conditions. 3. External indicators. Pending or threatened litigation that could have a significant adverse effect. Adverse legislation, regulation, or government action. Natural disasters or other external events that threaten viability. 4. Other red flags. Internal matters like working capital deficiencies or reliance on favorable transactions with related parties. Negative trends that persist without signs of recovery. The auditor must gather and evaluate all relevant information, then determine whether these factors collectively raise substantial doubt. Importantly, not every negative indicator means substantial doubt exists. Professional judgment is required to weigh the severity and likelihood of each factor. Think of going concern like evaluating if your phone will last a day. If the battery is already at 5% with no charger, financial losses. If the charging cable is broken, loss of supplier. And if the weather forecast says storms could knock out power, external litigation, or regulation, then there's real doubt your phone will make it. But if you just had a slow app for 1 hour, temporary dip in quarterly net income, that's not enough to conclude the phone is doomed. On exam day, remember, substantial doubt is about sustained conditions and risks, not minor temporary blips. All right, next question. When testing transactions related to federal awards for compliance with statutes, regulations, and terms of the award, which of the following procedures would be most appropriate? A. Confirm receivables with funding agencies. B. Compare expenditures to the approved budget in the grant agreement. C. Recalculate depreciation expense for capital assets. D. Review prior year audit opinion on the financial statements. The correct answer is B. Compare expenditures to the approved budget in the grant agreement. Here's why. Confirming receivables with funding agencies, A, may test existence and valuation, but doesn't directly address compliance. Recalculating depreciation, C, is a financial reporting test, not a compliance test for federal awards. Reviewing the prior year audit opinion, D, provides background context but doesn't test current compliance. Comparing expenditures to the approved budget in the grant agreement, B, directly addresses whether funds were spent in accordance with statutes, regulations, and the award terms, exactly what compliance testing is about. Let us look at the exam task on federal awards. Test transactions related to federal awards for compliance with statutes, regulations, and the terms and conditions of the federal awards. First off, what are federal awards? Federal awards are funds, property, or other financial assistance provided by the U.S. federal government to a non-federal entity, like a state, local government, university, or nonprofit, to carry out a public purpose. They can take the form of grants, most common, money for a specific program or project, contracts, agreements for goods or services for the government, cooperative agreements, similar to grants but with more federal involvement, loans, loan guarantees, or property, other types of assistance. In short, federal awards are the government's way of funding entities outside the federal system to achieve policy goals. For example, education, healthcare, infrastructure, or research. When auditors test federal awards, they aren't just checking accounting accuracy. They're checking compliance with laws, regulations, and the terms of the award. This type of work typically falls under the Single Audit Act and Uniform Guidance, 2 CFR Part 200. 1. Objective. The goal is to determine whether the entity complied with requirements that could have a direct and material effect on a federal program. This goes beyond debits and credits. It's about legal and contractual obligations. 2. Key compliance areas. Allowable costs, cost principles. Were expenditures allowable under the award's rules? For example, no charging entertainment or unapproved capital costs. Eligibility. Did only eligible participants benefit? Were required financial and performance reports submitted accurately and timely? Matching/level of effort. Did the entity provide required matching contributions or meet required effort levels? Cash management. Were draws of federal funds consistent with actual immediate needs? Procurement and suspension/debarment. Were procurement rules followed and were vendors eligible? 3. Auditor procedures. Compare actual expenditures to the grant agreement budget to confirm funds were used as approved. Trace selected transactions to supporting documents, invoices, payroll records, contracts, to ensure they are allowable and properly supported. Review compliance reports to confirm timely and accurate submission. Test eligibility requirements by reviewing participant records. Examine procurement files to verify compliance with competitive bidding and contractor eligibility rules. Evaluate internal controls specific to compliance requirements. 4. Professional skepticism. Just because management says the grant allows this doesn't mean it does. The auditor must read the award agreement and regulations and test actual expenditures against those requirements. Think of federal award auditing like checking if a scholarship was spent correctly. The scholarship agreement says, use this money only for tuition, fees, and books. If the student spends part of it on a beach trip, that's non-compliance, even if they argue it was educational. The auditor's job is to match expenditures to the approved budget rules in the grant, not just check whether the receipts add up. On exam day, if the question asks for the most appropriate compliance test, always think, does this procedure prove the money was spent the way the grant intended? All right, next question. An auditor is auditing a manufacturing entity and finds several misstatements. Some were corrected by management, others were left uncorrected because they were considered immaterial individually. The auditor also noted multiple control deficiencies in the purchasing process. Which auditor actions are appropriate? Statement 1. Prepare a summary of both corrected and uncorrected misstatements and communicate uncorrected items to governance. Yes. AUC 450 requires the auditor to accumulate misstatements, both corrected and uncorrected, and communicate uncorrected misstatements to those charged with governance. Statement 2. Evaluate whether uncorrected misstatements, individually or in the aggregate, could be material. Yes, even if misstatements are individually below materiality, they may be material in aggregate or qualitatively. For example, they affect compliance with debt covenants. Statement 3. Assess whether misstatements and control deficiencies indicate significant deficiencies or material weaknesses in internal control. Yes, misstatements and control deficiencies must be evaluated collectively. Multiple small issues may together point to a more serious weakness. Statement 4. Document that no further audit procedures are necessary since all individually uncorrected misstatements were below materiality. No, this misses the requirement to consider aggregate effects and qualitative aspects. Dismissing misstatements solely because they are individually small is inconsistent with standards. The correct answer is statements 1, 2, and 3. That makes the correct option C. Let's step back and connect this to the AICPA representative tasks. 1. Prepare a summary of corrected and uncorrected misstatements. Auditors must accumulate all identified misstatements regardless of whether management corrects them. A summary is prepared that shows corrected misstatements, those fixed by management, and uncorrected ones, those management left as is. This summary is communicated to those charged with governance so they are aware of the potential effect on the financial statements. 2. Determine the effect of uncorrected misstatements on the financial statements. Auditors cannot stop at individually immaterial. They must evaluate whether misstatements could be material in the aggregate or qualitatively. For example, a misstatement that changes a small profit into a small loss could be material even if the dollar amount is minor. Standards emphasize considering both size and nature. 3. Determine the effect of identified misstatements on internal control over financial reporting. ICFR are not only about numbers, they may reveal control deficiencies. For example, repeated errors in purchasing entries might suggest a weakness in review controls. Auditors must evaluate whether these deficiencies, individually or together, represent significant deficiencies or material weaknesses in ICFR. 4. Evaluate internal control deficiencies to determine the impact on audit procedures. Control deficiencies influence the nature, timing, and extent of audit work. If controls are weak, the auditor might perform more substantive testing, adjust the scope, or involve specialists. A strong control environment, by contrast, may allow reliance on controls with less extensive substantive testing. Easy analogy. Think of this like a classroom project. If 3 group members each make small mistakes, you can't just shrug and say, each one is small. When you put them together, the report could be a mess. That's aggregate effect. If those errors keep happening in the same section, it might also mean your group's quality check process is broken. That's a control deficiency. On exam day, remember, always summarize misstatements. Always evaluate both quantitative and qualitative impacts. Always assess control implications. Never just dismiss items as too small without looking at the bigger picture. All right, next question. Which of the following written representations is required from management in an audit of financial statements? Let's analyze each option. Option A. Management acknowledges responsibility for the design and implementation of internal control to prevent and detect fraud. Yes, AUC 580, written representations, requires management to acknowledge responsibility for establishing and maintaining effective internal control relevant to the preparation of financial statements, including controls designed to prevent and detect fraud. Option B. Management confirms that the auditor is responsible for preventing and detecting fraud. No. The auditor's role is to assess risk and obtain reasonable assurance about whether financial statements are free of material misstatement, but management, not the auditor, is responsible for preventing and detecting fraud. This option directly contradicts standards. Option C. Management represents that there are no estimates included in the financial statements. No, management cannot state that there are no estimates. Many financial statements include estimates, for example, allowance for doubtful accounts, depreciation, pension obligations. Instead, management must represent that estimates are reasonable and made in conformity with the applicable financial reporting framework. Option D. Management confirms that board minutes provide sufficient evidence in place of written representations. No, written representations from management are required regardless of board minutes. Minutes may provide evidence about governance decisions, but they do not replace management's written representations. The correct answer is A. Management acknowledges responsibility for the design and implementation of internal control to prevent and detect fraud. Let us take a look at the AICPA exam task on written representations. Identify the written representations that should be obtained from management or those charged with governance and an engagement. One of the critical tasks in an audit engagement is to identify and obtain the required written representations from management and sometimes those charged with governance. These representations are not optional. They are required by professional standards, AUC 580 and the AICPA framework, ISA 580 internationally. 1. Purpose of written representations. They confirm oral statements made to the auditor. They reduce the possibility of misunderstandings between auditor and management. They serve as audit evidence, though they are not a substitute for other audit procedures. 2. Required representations. Management's responsibility. Acknowledge responsibility for preparing financial statements in accordance with the applicable framework, and for designing, implementing, and maintaining effective internal control. Completeness of information. Confirm that all relevant information has been provided, including minutes, contracts, and other data. Fraud. Represent that management has disclosed its knowledge of fraud or suspected fraud affecting the entity, and any allegations of fraud communicated by employees, former employees, or others. Estimates. Confirm that significant assumptions and estimates are reasonable. Related parties. Confirm disclosure of related party relationships and transactions. Subsequent events. Represent that events occurring after the reporting date that require adjustment or disclosure have been appropriately dealt with. 3. Timing and format. The representation letter is dated as of the auditor's report date. It is typically signed by the CEO and CFO, or equivalents. In audits of smaller entities, the owner-manager may provide the letter. 4. Limitations. Written representations do not replace other audit evidence. If management refuses to provide written representations, it constitutes a scope limitation. The auditor may need to disclaim an opinion or withdraw from the engagement. Think of written representations like the final sign-off on a group project. The auditor is the reviewer, but management are the authors. At the end, management must sign a letter saying, "Yes, this is our work. We followed the right rules. We gave you everything you needed. We take responsibility." Without that signature, the project isn't officially complete. On exam day, remember, management signs for responsibility, completeness, fraud, estimates, related parties, and subsequent events. The auditor never accepts substitutes like board minutes or casual statements. All right, next question. While completing the audit of a retail company with a December 31 year-end, the auditor considers events occurring after year-end and prior to the report date. After the report is issued, new information also comes to light. Which auditor considerations and procedures are appropriate? Let's walk through this. Statement 1. Perform procedures such as inquiries of management, reviewing board minutes, and examining interim financials. Yes, these are required audit procedures under AUC 560 to identify subsequent events through the date of the auditor's report. Statement 2. Determine whether subsequent events provide evidence about conditions existing at year-end, type 1 events requiring adjustment, Or new conditions after year-end, Type 2 events requiring disclosure. Yes, this classification is fundamental to subsequent event evaluation. Statement 3. If subsequently discovered facts become known after the report date, evaluate whether revision and reissuance of the auditor's report is necessary. Yes, standards require auditors to take appropriate action if facts, had they been known at the report date, would have affected the report. This may include reissuance. Statement 4. Discuss with management that the auditor's responsibility for subsequently discovered facts ends once the report is released. No, that's incorrect. The auditor does have responsibilities for subsequently discovered facts that come to their attention even after report release. Those responsibilities don't vanish once the report is issued. The correct answer is statements 1, 2, and 3. That makes option C correct. Let us look at the AICPA representative tasks on subsequent events. 1. Recall the impact of subsequently discovered facts on the auditor's report. If facts are discovered after the audit report date that would have affected the report, the auditor must discuss the matter with management and those charged with governance, determine whether the financial statements need revision. If revision is necessary, issue a new or reissued report, usually with an explanatory paragraph describing the circumstances. If management refuses to revise, the auditor may need to notify users or regulatory bodies to avoid reliance on misleading financials. 2. Perform procedures to identify subsequent events that should be reflected in the current period financial statements and disclosures. Between the balance sheet date and the audit report date, the auditor performs specific procedures. Inquire of management, legal counsel, and those charged with governance. Review subsequent board minutes, examine interim financial statements, review legal letters and correspondence for potential contingencies. These procedures ensure material subsequent events are identified. 3. Determine whether identified subsequent events are appropriately reflected in the financial statements and disclosures. Two types of events exist under AUC 560 and ASC 855. Type 1, recognized events, provide evidence about conditions existing at year-end, for example, bankruptcy of a customer that was already in financial trouble at year-end. These require adjustment. Type 2, non-recognized events, provide evidence about conditions arising after year-end, for example, a natural disaster or new litigation. These require disclosure only if material. The auditor evaluates whether management has appropriately adjusted or disclosed events. If not, modification of the auditor's report may be required. Think of subsequent events like checking your phone after sending an email. Before you hit send, audit report date, you double-check spelling, attachments, and details. That's your procedures to identify subsequent events. If you realize 2 minutes later that you attached the wrong file, a type 1 event, you resend the corrected version, adjustment required. If instead the client emails you tomorrow saying, by the way, we decided to launch a new product, that's new information after the fact. You don't rewrite yesterday's email, but you may need to notify people, disclosure. On exam day, remember, type 1, adjust. Type 2, disclose, and subsequently discovered facts may mean revising the report.